Hey everyone, welcome to this month's Redwood Money client update. I hope that you and your family had a wonderful month of April. For Jordan, Sophia, and I, we had an awesome Easter, and this was a cute pic of us, so had to share it with you. You can see Sophia here. She's got a blue Easter egg in her hand, and she's looking off screen at another pink Easter egg that she was super excited to be crawling after. And in the last 3 months or 3 weeks, she went from not being able to crawl at all and mostly just sitting on the floor and being upset if she couldn't do something to now crawling, and she's a little maniac. She's all over the place. It is equal parts adorable and terrifying to have her able to be as mobile as she's been. But the Easter egg hunt was super fun with her cousins and with my parents, and just had a great time. I hope that you had a great month of April. And today I'm going to get into a few firm updates, some recommendations of content that you can check out. And then our big financial topic today is going to be on inflation. So as far as personal updates, the big one is Jordan and I are moving. We're moving from Sunnyvale to Campbell into a little bit of a bigger place. We're really excited about that. It also is exactly as stressful as you'd imagine to have a small business, to be moving out of a place and have a 9-month-old who's just started crawling. So please be praying for us as we finish this move, which should be done hopefully this weekend. The second thing is I read a lot of books on money, and part of the reason I do that is so that you don't have to. But sometimes I come across a book and I think, man, if every client read this, which is a pipe dream, but if you did, then they would understand their investments and their finances and just the way the world works so much better. And this book, Why Does the Stock Market Go Up?, written by Brian Feroldi, I read it this last month, and it's so helpful. It's really written so that a layman can understand what it means to be investing in a stock, to be investing in companies, and what impacts the fact that stocks have gone up. So I talked about that in my last couple of monthly updates of how the economy works a little bit, the long-term view of what stock prices have done. But this book gets into some of the fundamentals that underlie that. It's quick, 3-page chapters. It's funny, it's entertaining, and it's to the point. So unlike me, it's to the point, and you should read it. The third one is a podcast episode from my friend Peter Lazaroff, and he has a podcast called The Long-Term Investor. It's an excellent podcast. It's been going for the last couple of years, but he takes complex topics in money, he distills them down, and he delivers, this is a 12-minute episode that's really helpful and kind of moves past the headlines into real financial planning insights. So I highly recommend you check that out, and I'll put a link to it in this newsletter. Next couple of things are just remember, anytime you want to log into your financial plan and see your personal planning profile, you can do that at redwoodmoney.com. You can also log into Betterment using these QR codes on the screen or at betterment.com. But go ahead and check those things out. With that, we're going to move into our topic of the day, which is inflation, which has been making a lot of headlines because inflation came in at 40-year highs in the most recent calculation, at an 8.5% increase over the last year for the March reading, which came out in April. And because I don't want to be like your boring economics teacher, I'm going to keep this quick, and I'm going to start with memes. So our top 5 inflation memes, I was cracking up reading these because sometimes you just need to laugh when things are so chaotic and crazy financially. First one, inflation is so crazy, even Tom Brady is coming out of retirement. Second one is inflation. By the time you can finally make ends meet, they move the ends. That's what living in the Bay Area and trying to buy a house actually is all about. It's about that specific meme. Third one, when you get a 2% raise, but inflation is at 6.5%. We've been so spoiled. The last decade, inflation has been hovering at or under 2%, which is the Federal Reserve's target. And now inflation goes up, and all of a sudden it's like, man, I'm earning more, but it feels like it's not going as far. And that's exactly what inflation does. Fourth one, a little bit less depressing than the last couple. I ate a popsicle and ended up with $38 in lumber. I have a few friends in the real estate industry, and they've been talking to me about how crazy the combination of materials costs increasing and supply chain challenges have been, and I thought that captured it well. And then if any of you have been driving a car or looking to buy a new car, you'll love this one. High price of gas. Biden said buy an electric car. With the inflation rate, this is what I could afford. So that's it for the memes. Now I'm going to get into the educational portion. And if you want to just skip ahead, I'm going to give some financial planning moves to make based on the inflation. And that'll probably be in about 8 to 10 minutes. And if you'd like to, I do think it makes sense. I'll try to keep it quick, but to talk about inflation, what it is, how it's measured, and what's going on currently. So what is inflation? Inflation is the decline of a given currency's purchasing power. So we'll be looking at the dollar over time, or alternatively, this general rise in prices. So we see this when we go to Starbucks, and every year, your iced coffee gets 15 cents or 25 cents more expensive. When you talk to people who are more experienced than us and they talk about back in their day how they could get a Coke for a nickel, that's inflation at work. It's that your dollar doesn't go as far now as it used to. And this chart shows historical inflation from the 70s up until now. And you can see in the 70s and 80s, there were some periods of extreme inflation in the US. And that often was tied in with these gray bars, which is recessions that happened. But actually, since the 80s, when the Federal Reserve really raised interest rates, we've seen inflation drop and be very contained over the last 30 years or so. And that's a great thing for consumers. It's been very reasonable. And now as we see inflation uptick, it's got people concerned, and for good reasons. So how is this measured? It's measured in a lot of ways, but one of the most common ones that we see is the CPI, or Consumer Price Index, which is an index that tracks over time the change in cost of a weighted basket of goods. So things that everybody in society buys, it takes a look at them, and there's a couple of different ones. You've got all items, that's this blue bar, and then excluding food and energy, which can be a little bit more volatile, that's that red bar. And the headlines recently were that we're seeing basically a 40-year high in inflation in CPI because of a confluence of factors that have been happening. So let's talk a little bit about what's actually underlying that measure, because not all inflation is going to impact you as a consumer, why some inflation is actually a really good thing, and why we have a target inflation rate that's positive, and then what's impacting inflation today. So first, what's included in CPI? Headline inflation, that CPI number, which was 7% at the end of last year, and it's upticked to 8.5%. It's a weighted index. That means that of all these things like housing, food, transportation, education, each different measure has a different weight. So that's these orange numbers. You can see the biggest one is typically a household's biggest expense, which is housing. And then that's followed by food and transportation. Those are the double-digit parts of the reading. And then you can see in this yellow, here's the price change of those different items as part of that reading. And so housing went up by 5.1%, food was up 6% at the end of last year, transportation was up big at 21%. But each of those measures has submeasures underneath it. And so what caused those rises? You can see for housing, you might think 5.1%, that's really high. But a big part of that was that at the end of last year, as people are opening up travel and we're traveling more, that lodging away from home, so whether that was an Airbnb or a hotel, that went up by 24%. And that led to an uptick in this housing measure. Now, where this is relevant for you is you might see this headline inflation and think, man, that's really scary. But if you've been living in the same place with a long-term lease or a mortgage, that housing increase hasn't really impacted you. Now, if you're shopping and you're in the housing market, it really impacted you. So each household is going to be impacted differently by these measures. I think transportation is also interesting because this shows some of the weird stuff related to pandemic supply chain, that of this 21% up, it's a combination of things like new cars being much more expensive as there's been this chip shortage, but then car and truck rentals up 36%. So if you weren't renting a truck in the last 6 months or car, then you were probably fine, but you noticed it if you went and you were doing that. When I talk about budgeting with people, typically the 3 items that we'll focus the most on, you can guess what they are. They're the cost of housing, the cost of food, and the cost of transportation, because those make up over 50% of this measure, and they typically make up 50 to 60% of your budget. So if we can find cuts there, it can make a big difference. So wanted to show you what's included in CPI and also let you know this helps you to see which things to maybe focus on in your budget because they're abnormally high. Now, what's happened in the last few months, even since this data came out, is because of Russia's invasion of Ukraine and Russia being a major oil exporter, we've seen gasoline prices really increase. So up over 50% year over year and still rising. And that's something that a lot of new drilling is happening. We're talking with places like Saudi Arabia and Argentina and places that were sort of personas non grata over the last many years are being trying to open up in order to kind of unlock some of the capacity in oil. But what happens is that as CPI increases, you're seeing that number 7%, well, it's made up of a whole bunch of other numbers that may or may not be relevant to you. So that's what's included. Now let's talk a little bit about why inflation, generally speaking, can be good, because people don't like this number, but some inflation, a target of 2% is what the Federal Reserve has, can be good because it's actually a sign of a healthy economy. This steady rise in prices makes sense. And here's the inflationary cycle. What happens is prices rise as the economy grows because demand for stuff increases. And an economy is going to organically grow as more people enter the workforce, as companies become more efficient in producing stuff. And so prices rise and the cost of goods increases with that rising demand. Well, then what that happens is because those prices are a little higher, then companies, they want to take advantage of that and their earnings rise as more stuff gets bought. So Apple reported earnings yesterday. They reported record earnings on the back of higher iPhone sales, Mac sales, services sales because of our very, very healthy economy currently. And so suppliers, they up their prices and their production in order to get those higher earnings. Well, those earnings, part of companies earning more is that workers earn more, and so their wages rise. So while prices are rising, as long as their wages are rising at a similar rate, you aren't bothered too much as a consumer because you're earning more, which allows you to afford those increases in prices. As those wages rise, what happens next? Well, people have money, they want to spend it, and so they increase their spending. And as a result of that increased spending, demand increases because dollars are chasing the same good, prices rise, and we see this cycle continue. So this is why economists would say that because workers with higher wages buy more stuff, you get this virtuous cycle that's continuing. So it's not that inflation is causing this to happen, it's a symptom of a healthy and growing economy. Now, the opposite of this can also happen, and that's in a deflationary cycle. And in a deflationary cycle, the prices of things are falling. And this is a really bad thing because if the prices of something that I want is falling, then I'm not going to buy it now. I'm going to wait and I'm going to buy it later when the price is lower. Well, what that's going to do is it's going to cause earnings to go down for companies. And those companies may lay off workers, which causes wages to decline. And then when wages decline, spending decreases, which means that prices fall because producers, they need to sell their stuff and there's less demand, and that causes earnings to fall. And so you can see that deflationary cycle, that's a scary thing. And so economists and the Federal Reserve and our government, they're looking at these factors and they're trying to keep our economy growing. And part of that means having a certain percentage of inflation. And you may have heard recently that interest rates are rising and that we're coming out of this period of really low interest rates. What does that have to do with inflation? Well, there's a lot going into the economy, but at a very simple level, the Federal Reserve Bank is basically tasked and was created and then reformed in the 1980s to try to really help the economy to have a little bit of a smoother ride, to have fewer recessions, to have steadier prices, and to keep employment up. And so the Federal Reserve, or the Fed, has this dual mandate. And the two jobs that they have are to keep employment up, have employment at a stable level, and then secondly, to keep prices stable. And another way to say keep prices stable is to keep inflation low. And the Federal Reserve has tools that they can use in order to influence these two things as parts of their mandate. And a big one is that they control a very important interest rate that is charged to banks called the federal funds rate. And that federal funds rate that's charged to banks, it kind of trickles down to us as consumers because it influences the rate that we pay on credit card interest, on our home loans, and on our auto loans. So what happened during the pandemic is the Federal Reserve and the broader government looked and saw that our economy was about to be shut down, and we did go into a brief recession. But in order to try to keep employment up and keep prices stable, a few things happened. First thing they did was they decreased interest rates to near 0%. Well, that stimulates the economy because if it's really cheap to borrow money and to spend it, people are going to borrow and they're going to buy cars and they're going to buy houses and they're going to buy big ticket items. And as they do that, cars need to be produced, houses need to be built, or they need to be sold. When they're sold, when a house is sold, right, there's a lot of work that gets done on it. People maybe refinance money out of their house because interest rates are low, and so they spend that. And so all of that works towards keeping employment up. And as far as keeping prices stable, during the time of the pandemic, when people weren't eating out, they weren't doing as much, the Fed went a step further and they began buying assets in the open market. They bought bonds, they bought stocks to try to keep prices up and to keep companies healthy. Another thing we did to keep employment up during the pandemic was the Paycheck Protection Program, which was a lot of money that was released to employers to keep their employees on payroll even if they weren't working. And all of these measures, they were smart measures that were taken. They might have been overdone, but they were taken during this time of huge economic distress in order to kind of keep things going. And now what we're seeing on the other side of this is there's a huge amount of money that has joined the economy and things are reopening. There's a lot of competition for things. And so inflation is rising. So what's causing the price inflation? Well, it's a combination of factors. The first one is we're seeing that countries around the world, they provided this stimulus, like I talked about, during the pandemic by reducing those interest rates and printing a lot of money. So that money came to us in stimmy checks, but it came through the Paycheck Protection Program. It came through a lot of stimulus, trillions of dollars that were printed to try to just prop up the economy through this difficult period. Not only that, but people couldn't always spend the money during the lockdowns. And so as the economy is reopening, people have savings and we want to spend. We want to go to Disneyland. We want to take those trips that were delayed. We want to spend on things that now that we're not as afraid of getting laid off. All of that spending is stuff that's happening, but we're competing for the same goods. Now, the third thing is the economy is super strong and there's very low unemployment. And with that competition for the same jobs and the same goods, wages are rising, which means that there's more money that's going for the same amount of goods. All of that drives prices up. And you can see this graph here. It shows our unemployment levels currently are among the lowest that they've been in the last 20 years. So the economy is really healthy. It might not feel that way, but part of the reason the Federal Reserve is raising interest rates is because they're seeing this and they're trying to reduce inflation. When they raise those interest rates, it makes it more expensive for companies and individuals to borrow, which reduces spending and can try to tamp down inflation. What else happened? The COVID pandemic really messed up supply chains, which is artificially reducing the goods available. And that's still happening. We're seeing that with lockdowns in Shanghai and cities in Asia that are huge producers. And so that is making it so that not only is there a huge demand for goods, but there's lower supply due to the pandemic and some of the weird things that happened in the last couple of years related to that. And then finally, to make matters worse, Russia invaded Ukraine, which is driving up key prices of energy and wheat. And so just, thanks Putin for that, because as if things weren't hard enough already, you've got this awful humanitarian crisis and people trying to figure out what to do with that. So all of this is causing the inflation. And it raises the question, what do we do? What do we do? I think listen to that podcast that I shared with you of reasons not to be concerned about inflation. What we are seeing is that inflation it's probably peaked, and I'm saying that with like fingers crossed and knocking on wood because people have been saying that for months. But it has probably peaked, and now the Federal Reserve is raising interest rates to try to reduce it. And we have to ask ourselves, because we can't change what's happened with inflation, what can we do as part of our financial plan? So if you just tuned back in because you wanted to skip the lecture, welcome back. It's great to have you. And let's talk about 6 things that you can do in an inflationary rising interest rate environment. The first one is consider asking for a raise. We're in a super tight labor market with 3.6% unemployment. That means that companies are competing for workers and most people are employed who want to be employed. This is a great time to either try to negotiate a raise because your employer doesn't want to lose you, or to be open to a role that could pay more, right? If you're open to moving to another place in this competitive job market, it could be an opportunity for you to make more money, which would make it so that inflation doesn't hurt quite as much. The second note is what inflation means is that your cash is losing value. So it's really important as part of your financial plan that we right size your cash position. Doesn't mean get rid of cash, but you want to make sure that your cash has a few different uses. One, you need an emergency fund, a liquidity amount of 3 to 6 months of your expenses. And so we have that in your financial plan. We want to make sure you've got that emergency fund in place. Then I like to also have a buffer in my checking account that's 1 month of cash, so I'm not going to overdraft it, and I've always got that buffer. And then the third thing, cash is really good for short-term things. If you need the money, it's liquid, it's available to you. You want to put that into a place that is not invested in the market. So if you have near-term big expenses, whether that's buying a home or you're paying for a year of your child's college or some other big expense, we want to keep things that's for 18 months or sooner still exposed to cash. If it's longer than 18 months, we might put it in bonds or invest it in the market. Now with the cash that you have, this is a great opportunity for you to open an online high yield savings account. I love Ally Bank. They've done a really good job of staying at the top level among savings interest rates. And what you can see in this chart is this is looking back at the 2016 to 2018 time period. And you can see the online deposit rates for savings accounts were always higher than the average national bank. So this is Wells Fargo, it's Chase, it's Bank of America. All of them are paying 0.01% on your cash. Right now, this number is closer to 0.5% for the high yield savings account. But what I wanted you to pay attention to is as the Federal Reserve raised interest rates, which they did last month and they're going to do next month. Last month, they raised it from 0% up to 0.25% to 0.5%. In May, they're expecting this interest rate to go up to 1%. And notice that when this happened in 2016 to 2018 and the federal funds rate increased, online banks started raising their interest rates. So my expectation is if the Fed continues raising interest rates, you'll not only earn the 0.5% that you'd earn in Ally Bank right now, but that number might increase to 1% or 1.5%. So especially with this emergency fund or money for near-term expenses, if this is tens of thousands of dollars, you might as well be earning interest on it in a way that you haven't been able to in the last many years by putting it into a high-yield savings account with a place like Ally Bank or Synchrony Bank or SoFi, a company that is online and digitally led that will pass on those higher interest rates to you instead of hanging on to them like those large banks would, like Wells Fargo and other places. I say Wells Fargo because I'm at Wells Fargo and I use them for checking, but I don't keep savings money there. All right, your fourth financial planning move is just to stay flexible. I showed you earlier that there are different areas that have been really hit by inflation, things like the cost of used and new cars, things like certain areas of food. If you can be flexible and maybe you delay the purchase of the car by a few months, or if you want a new car, you just buy a used car for the next year, even if it's more expensive, knowing that there's going to be a lot more supply that comes online in the next couple of years as the chip shortage eases. And as a result, there's going to be more cars that are available. And so don't pay a $10,000 or a $15,000 premium on a car if you can avoid it, especially with those big ticket items. If you can be flexible to stay within your budget by looking critically at what's happening with prices, and if this is something that you can either defer and make the expense later or do something different, right? Still take your vacation, but maybe go to somewhere that doesn't require you to fly halfway around the world. There are always options within your financial plan, and if you're feeling financially strapped, then being flexible allows you to not be hit as hard by these inflationary pressures. The fifth one, and this is a long-term solution to inflation, this is always a threat to your financial plan, inflation. your cash is going to lose value over time. So for those long-term goals that we have, like retiring, maybe buying a home or buying investment real estate, or just leaving a legacy to your heirs, sending kids to college, we want to own appreciating assets that can beat inflation over time. So what's done that? Real estate has done that. Stocks have done that. Bonds have done that. They're not quite doing it right now. They're not quite beating inflation. But investing in assets that will appreciate and beat inflation over time makes sense. The historical average over the last 100 or so years of inflation is right around 3%. So we're above it at 8.5%, but you needed to be earning more than 3% for your money to maintain its purchasing power and to grow its purchasing power. Well, stocks have earned about 10% over that time period through a combination of increasing their earnings and releasing dividends. So that appreciation plus the dividends from stocks has been about 10%, whereas inflation has been 3%. That's really good. It means that your cash is being put to work in a way that means you keep your purchasing power. And my sixth and final point of financial planning in an inflationary, rising rate environment is that what's going to happen is prices are going to rise. Whether because inflation stays at 8.5% or it drops to 5% or goes down to 3%, you as a consumer are allowed to buy things. You're more than a consumer, but I think part of having money, it's not just to accumulate more and more. It's to be able to enjoy it, to live generously, to spend, to invest. Don't be too stressed out. If you've got in your financial plan enough cash to support those immediate near-term needs and you want to take a vacation and it's in your plan, go ahead and do it. Don't stress out about it. You can't control what's happened in the financial planning world, but or you can't control what's happened in the broader economy with inflation. But I'm here as your financial advisor to tell you if we've planned for it, go ahead and spend the money and spend it guilt-free. You probably said no to so many things over the last few years. And now you've got an opportunity to say yes to some things. And if we've already made a plan for it and it works inside of your plan, then you having that permission to spend, it's there. And maybe this is what's causing inflation in the first place, is people have become, less sensitive to these increasing prices. But it's going to be something that a lot of people are going to work to reduce the inflation. And for you, in these next few months, it's okay if you want to spend a little bit of money to do that, even if it's a little bit more expensive than what you had planned. You've probably earned the right to do that with the way that your spending has been over the last few years. So I hope this was helpful. I hope it was educational for you. And I look forward to connecting with you for next month's client update. If you have any questions or topics you'd like for me to cover in the future, go ahead and ask a question in the comments on this video or respond to the email that you got the video in, and I'd love to hear what you'd like to hear about next. Thanks.